The stock market is still hovering right near all-time highs, and I have continued getting asked if now is the time to buy stocks, build cash, or wait for a correction. So in today's video, I want to go over the current fundamentals of the S&P 500, its price, where returns have been coming from, and the returns investors have gotten by buying at all-time highs before. This video is packed with interesting and useful information, so let's just get right into it. Alright, so the screenshots that we are going to be discussing in this video all come from JP Morgan's Guide to the Markets, which they put out on a quarterly basis. And they recently put out their Guide to the Markets for March 31st, which was just about a week ago now. So here we can see that the forward price to earnings ratio of the market is now sitting at around 21. If we take a look throughout history, we can see that the forward price to earnings ratio in February of 2020, before COVID happened, was 19.2. Then in 2007, before the Great Recession, it was about 15.1. And during the tech bubble, it was 25.2. So right now, the market is more expensive than 2020 and in 2007, but not quite as expensive as during the tech bubble. But it is starting to get up there. Now, additionally, we do need to take the 10-year treasury into account because this is the risk-free rate. So again, right now it is sitting at 4.2%, and the most similar time frame that we do have here is 2007, when the 10-year treasury was 4.7%. Now again, at this time, the market had a forward price to earnings ratio of 15.1. So I would say that today the stock market is quite a bit more expensive than during 2007. And overall, I do believe that the S&P 500 is on the more expensive end right now. And personally, I am not interested in buying the S&P 500 index. Even if I were an index investor, I would not be buying right now personally. Now this next slide shows us the 30-year average forward price to earnings ratio of the S&P 500. And here we can see that it is about 16.62. And again, the market is currently sitting at a forward price to earnings ratio of about 21. Now I added in this red line throughout history, and we can see that again, the market is on the more expensive end. There's only been roughly 2 times in the past where the market has been this expensive over the past about 30 years. And that was in 2021 and all the way back here during the tech bubble. So we're not quite at tech bubble levels yet, but it looks like we are approaching those levels. So if the market continues expanding at a faster rate than overall earnings are growing, then we will get up to tech bubble forward price to earnings ratios here pretty soon, I think. But we're not in bubble territory quite yet. We are just in a pretty expensive market, in my opinion. Now, this next slide is very interesting to me because it shows the 1 and 5-year returns that investors can expect when the market is trading for a forward price to earnings ratio of 21. So historically, when the market has been this expensive and traded for this price ratio, the 1-year returns have been about 1 to 2%, or very low. The 5-year returns have also been very low at around 3 to 5%. Now, additionally, what these charts show us is that as the price to earnings ratio of the market goes up, the future returns go down. So this very clearly shows us that the higher prices that investors are willing to pay for their stocks, the lower future returns that they should expect. And by all logic, this is what people should expect. The higher price you pay, the lower future returns you're going to get. Now, why this is interesting is because personally, I feel like we are kind of in a market again where people aren't really considering price at all. I mean, when you take a look at Nvidia, or you take a look at Tesla, or even Microsoft right now, a lot of people are willing to pay roughly 50 times cash flow for Microsoft just because it's obviously going to grow in the future. But when you pay those high of price ratios, you really should be expecting your future returns to be quite low. But when I say this, I do see a lot of comments on my YouTube channel of people just saying that Microsoft is an incredible business, an extremely high quality business, so you shouldn't worry at all about the price you're paying. Now, I'm not going to debate that Microsoft is an amazing business. It is an absolutely incredible business, but every business has a price that you should be willing to pay for it. And for me personally, a 50 price to free cash flow for Microsoft is way too high, even for how high of quality of a business it is. And it all comes back down to these charts right here, or the logic that these charts are showing. And that is that the higher price you pay for a business, the lower your future returns are going to be. So that's something that I think investors should consider. And again, it's something that I think the market, or some investors in the market right now, are not considering at all. Now, moving on to the next slide right here, this one is very quick. All I want to point out is that analysts are expecting the EPS of the S&P 500 to grow 11% in 2024 and 13% in 2025. So it looks like analysts are actually quite bullish on the future growth of the overall S&P 500 and the earnings growth of the S&P 500 over the next 2 years. This is double-digit growth rate, which is pretty strong. So I don't know if everyone agrees with that. I would be a little bit more bearish, I think. But yeah, that's what analysts are currently expecting and pricing into the market. Now, this next slide right here shows us the relative price differences between growth stocks and value stocks. And right now we can see that value stocks are cheap relative to growth stocks. However, if we take a look at the current forward price to earnings ratio of value stocks, they are sitting at about 16.1, whereas their long-term average is 14.1. So even versus their own long-term averages, they are expensive right now. It's just relative to growth stocks, value stocks do look quite a bit cheaper. And that is why they are down lower on this overall chart. But overall, the S&P 500 does actually look quite expensive to me. Value stocks look kind of expensive, growth stocks look especially expensive, and the Magnificent Seven, well, a few stocks in the Magnificent Seven look very expensive to me. Now, moving on to the next slide, this one talks about the top 10 stocks in the market, then the remaining 490 stocks. So right now, the top 10 stocks have a forward price to earnings ratio of 28.4, and their average has been about 20.3. So they're selling about 40% above their historical averages. The remaining stocks are also selling at about 17% above their historical averages, which again kind of suggests that the entire market is more on the expensive end right now. Now, what's also interesting is the weight of the top 10 stocks in the S&P 500 is now sitting at 33.5%, which is actually a 30-year high. During the tech bubble, the top 10 stocks were weighted at about 27%. So the top 10 stocks now make up 33.5% of the entire S&P 500, which is about a third of the overall index. So the index is becoming more and more concentrated in just 10 stocks. And that is something that, I'm considering when I'm taking a look at the index as well, even though I'm not an index investor. But that's just kind of something that I thought was pretty interesting. Now, moving on to the next slide, this shows where the historical returns of the S&P 500 came from in 2022, 2023, and year-to-date so far in 2024. Now, it is worth noting that in 2022, the Magnificent Seven saw a decline on average of 40% to their share prices, whereas the S&P 500 only saw a 8% decline to share prices. So basically in 2022, the Magnificent Seven stocks saw massive corrections versus the overall index. Then in 2023, the Magnificent Seven increased their share prices by about 76% relative to only 8% for the S&P 500. So the vast majority of the overall index's returns in 2023 came from this group of stocks. Now in 2024, they have produced 13% versus the S&P's 6%. So it does look like the majority of the returns so far this year are also coming from the Magnificent Seven. And these stocks are getting more and more expensive. Microsoft, I do believe, is very expensive. Nvidia is very expensive. Tesla is very expensive. And these stocks just seem to continue going up, except for Tesla. All right, moving on to the next slide now. This is the household debt service ratio, which is currently sitting at 9.9%. And relative to historical averages, this is actually still quite low. So debt payments as a percent of disposable income is actually still quite low. For example, here during the Great Recession, it was about 13.3%. And sorry, that was right before the Great Recession. So this is still low on a relative basis. However, flows into early delinquencies for auto loans and credit card loans are starting to spike up quite a bit here. We can see that they are clearly uptrending. Now back here during the Great Recession, credit card delinquencies were up to 14%, so they still have quite a ways to go. But this is something that I am keeping my eye on because the delinquencies for these loans are definitely ticking up right now. Moving on to the next slide, this talks about personal savings rates. So in 2024 year to date, the personal savings rate is only 3.8%, which is well below the, 60-year historical average of about 8.5%. I personally think that this is due to inflation, and inflation causing us to have to spend more money relative to our income, which overall means that people aren't able to save as much money right now. Additionally, household excess savings from COVID are down 1.5 trillion from their peak to about $800 billion left. So again, at the peak right here, when everyone was getting free money from the government, we had excess savings of $2.3 trillion. Since then, we have consistently been spending these excess savings, and now they're down to $800 billion. This overall suggests that people are still spending more money than they are earning because they are blowing through these excess savings. And it's going to be interesting to see what happens when these excess savings finally hit zero and people no longer have all of these extra savings from COVID. And at this rate, that will probably happen within the next year. So yeah, we're going to have to see what happens when people run out of these extra savings that they have. Now, moving on to the Consumer Sentiment Index. Now, for those of you who do not know, typically the Consumer Sentiment Index, when it's low, it tends to be a good time to buy stocks. For example, in June of 2022, the Consumer Sentiment Index hit a 50-year low. And during this time, this is when the stock market was seeing that massive correction. And during this time, I was making videos pointing to this chart saying that, at least historically, this has been a good time to buy stocks. When people are overall bearish on the economy and bearish on the stock market, it tends to create cheap prices within the stock market. And I mean, if you take a look at Google's price to free cash flow in 2022, it got all the way down to 15, which was a decade low. So people were quite bearish on the overall economy in 2022 when the consumer index was at its 50-year low. Now we can see that consumer confidence has rebounded massively, and with it, so has the stock market. Now, this is not on the super high end. Consumers still seem like they are net bearish, but overall, we can see that it has had a massive rebound, and overall, we have seen a massive rebound in stocks as well. So this is something that I do pay attention to, and it's just nice to see when the consumer index is low, you can kind of look for opportunities within the stock market because you're probably going to find cheap stocks as well. Now, this next slide talks about the expectations for the federal funds interest rate. And we can see that people are now expecting the Fed funds rate to drop to 4.6% by the end of 2024. Then in 2025, we're looking at about 3.9%. So interest rates are projected to continue dropping over the next 3 years here. And long term, it does look like the Fed wants to get interest rates back down to 2.6%. Which is about half of what they are today. So that's kind of the outlook right now, is some rate cuts in 2024 and then continued rate cuts over the next couple of years. But it looks like rates, at least based on the data right now, looks like rates have peaked. All right, moving on to the international markets right here. This chart on the left-hand side shows us the relative price between the S&P 500 and the all-world index. So it's basically how expensive the S&P 500 is relative to the international markets. And right now, the international markets are sitting at a 20-year low relative to the S&P 500. So that overall can suggest that the international markets are looking quite cheap relative to the US markets. However, what's interesting is the all-world index is selling for a 13.7 price to earnings ratio today, whereas its 20-year average is 13. So it is still slightly more expensive than it has been over the past 20 years, but relative to the S&P 500's price ratio of 21 today, it does look quite cheap. So this data could suggest that there are opportunities in the international markets rather than the US markets right now. And I have been saying this on my channel recently as well. I do believe that the international markets are offering a lot more value than US stocks today. Now, additionally, this chart on the right-hand side shows us that the US market is again trading for that 21 price to earnings ratio today. And the purple bar here is the 25-year average price to earnings ratio. So once again, we can see the US market is trading well above its 25-year average. Now, if we take a look at Japan, it is trading below its 25-year average. Europe is trading slightly above its 25-year average. The emerging markets are trading slightly above their 25-year average as well. And China is trading well below its 25-year average by a significant amount. And when we take a look at this, Chinese stocks are clearly the cheapest stocks in the international markets right now. They're selling well below their own historical averages. And on just a neutral basis, they're trading for a 9.3 forward price to earnings ratio, which I do believe is quite cheap. That's less than half the price of the US stocks right now. I also made a video on my channel recently going over Alibaba and explaining why I believe that that stock in specific is so cheap right now. And just to quickly summarize, it's trading for about 7 times free cash flow, which is about a 13% free cash flow yield, while its revenue is at an all-time high, and its free cash flows are right near an all-time high as well. So the fundamentals for that business have pretty much never been better, especially when we consider the $87 billion of cash that they have on the balance sheet. So fundamentals have basically never been better. They're sitting at an all-time high, but the price ratios are sitting at an all-time low. Again, a price to free cash flow of only 7. So based on the data and based on how low the price ratios of Chinese stocks have gotten, I would actually say that the investor sentiment towards China is at an all-time low because, again, Alibaba's price ratios have never been this low, not even close, and these price ratios are incredibly low. So while the sentiment is bad and while people do not want to own Chinese stocks, personally, I do believe that this is what creates opportunity in the market, and it's the negative sentiment that creates low price ratios and alternatively high free cash flow yields. So that is why I have recently added more Alibaba to my portfolios. That's also why I made that video saying that I do believe that Alibaba is cheap in the market right now. And when we take a look at this, we can also see that in general, the Chinese stock market does look very, very cheap. All right, moving on to the US imports data. Here we can see that Chinese imports to the US have fallen off a cliff over the past about 6 years. Now, if we take a look at Mexico, which is this blue line, it is now the #1 single country importer to the US, and it has overtaken China. Now, this is why I bought CP Rail recently over the past few months, because CP Rail is the only rail network that connects North America. They have access in Canada, obviously being Canadian Pacific. Then they have rail networks in the US, and their rail network now goes all the way down to Mexico. So while Mexico's imports to the US are growing and now are the #1 single country importer to the US, I do believe that CP Rail is going to see massive benefits from this now that they do own all of those tracks and connect all 3 North American countries. Now, what's also interesting is Taiwan, South Korea, and Vietnam are seeing a massive growth trend to their overall imports into the United States. And it's actually like, it looks like it's accelerating. So that is also something to note because these are emerging markets over in the Asia Pacific region. All right, now let's move on to the GDP growth expectations for India, China, emerging markets, and the United States. So right here, we can see that India is basically projected to grow its GDP annually by over 6% over the next 5 years. China is projected to see between 3 and 5% annual GDP growth. The emerging markets are projected to see about 4%, and the US is projected to see about 2%. Now, why this is interesting to me is because it looks like the emerging markets, including India and China, are expected to see significant more GDP growth than the United States. Now, why this is also interesting is because, again, China is the cheapest international market right now, yet their GDP growth is projected to be significantly more than the United States. So cheap prices with overall expected strong economic growth, I think does also make a case that China does look like it does have some opportunity in those markets. And the US arguably could be quite expensive right now as well. All right, moving on to the final slide we are going to talk about in this video. This one is very interesting to me, and this is a new one that JP Morgan included in their overall deck. So this chart on the left-hand side shows us the percentage of days the S&P 500 closes at all-time highs, which is 6.6% of the time. However, the percent of all-time highs that act as a market floor is basically 30%. The market floor means that the market never goes back down to that price again. What this means is that statistically, it is actually better to buy at all-time highs than wait, because 30% of the time, the market will never see that price again. Now, on the right-hand side, you can see the returns you can expect by buying at all-time highs as well. And this actually kind of shocked me, because the returns you can expect buying all-time highs also beat investing on any other day of the market. So apparently, buying all-time highs actually produces more long-term returns than buying on any other day of the market. So why is this? Well, to me, it seems like it's because when the market breaks out and makes a new high, again, 30% of the time, it never actually gets back down to that price. So statistically, 30% of the time you buy an all-time high, you're buying a price that you will never see again. And this is very interesting. However, personally, I do think this data is a bit subjective and also depends on more market conditions. For example, in 1997, the market hit an all-time high. And in 2009, the market hit that level again. So over this 12-year period, you actually would have not made money. There's also periods, such as the tech bubble, where stocks got so expensive that they didn't make a new high for 13 years. So for me, I think price, once again, is a huge consideration that investors need to factor in. But those are all of the slides that I have to share today from JP Morgan's most recent guide to the markets, again, that they put out on a quarterly basis. Overall, in my opinion, it does look like the market is on the more expensive end, and it looks like the top 10 stocks especially are arguably quite expensive. However, when we take a look at the international markets relative to the US markets, they do look like they are offering a significant amount of value, especially the Chinese markets. So personally, I am looking outside of the US markets right now, and I'm actually finding a lot of value in the Canadian markets. And as my Patreon members know, I have been buying a lot of smaller cap Canadian stocks. And if you want access to these stocks, then make sure to go and sign up to my Patreon and you will see my entire personal portfolios and all of the stocks that I am buying in real time. But again, right now, I do feel like the US markets are quite expensive, so I am focusing on the international markets. And if the US markets do see some sort of correction, and for example, Google gets back down to that 17 price to free cash flow or 15 price to free cash flow, then I will be buying US stocks massively. But right now, it's just not where I'm seeing value, so I am looking in other markets to continue adding more money to my portfolios because I am a net buyer of stocks, and I am just wanting to continue buying more and more stocks over time. But it is getting more challenging to find value, but I do still believe that there is value in the markets if you know where to look and you do know how to analyze businesses. But that is going to wrap up the video for today, everyone. So thank you so much for watching. I truly do appreciate it. And if you did enjoy this video, then please remember to leave a like on it and let me know your thoughts down in the comments section below. I make these videos on a quarterly basis, and the audience usually seems to love them. So let me know if you did as well. Also, if this is your first time here on my channel and you want to see more content like this and stay up to date with the stock market and the stocks that I am buying, then make sure to subscribe to the channel as well. But with that being said, that is going to wrap up the video, everyone. So thank you so much for watching. I truly do appreciate it, and I really hope to see you all again in my next video.